Welcome to Mathematical Finance. Today we are going to explore one of the most beautiful and fundamental relationships in all of options pricing, known as put-call parity. Imagine being able to guarantee a future purchase price for an asset using two completely different financial strategies, yet ending up with the exact same result. By the end of this lesson, you will understand how this simple idea keeps global markets perfectly balanced and prevents free money from existing. Before we look at any equations, let us understand the core philosophy behind options pricing, the no arbitrage principle. Imagine you want to guarantee the purchase of a gold coin next year. You could buy the coin today and get insurance against a price drop, or you could put money in the bank and buy a coupon giving you the right to buy it later. Both paths lead to the exact same financial destination. Because the final result is identical, the total cost of both strategies today must be exactly the same. If one were cheaper, every trader would buy the cheap one and sell the expensive one to make free money. This balancing act is what we call put-call parity. To understand how this balancing act works, we need to construct two specific financial portfolios. We will look at their value at the expiration time, which we will call capital T. Portfolio A is called a protective put, meaning you own one share of the stock and you also own one put option to protect against price drops. Portfolio B is called a fiduciary call. In this portfolio, you own one call option and you also have cash sitting in a bank account that will grow to exactly K dollars by time T. Let us see how these behave. By equating the present-day costs of these two portfolios, we arrive at our fundamental mathematical relationship. This is the put-call parity equation. On the left side, C represents the current price of a European call option, and K e to the power of negative RT is the present value of the strike price, discounted continuously at the risk-free interest rate R over time T. On the right side, P is the current price of the European put option, and S0 is the current stock price. If the call price increases, the put price must also increase to keep this equation perfectly balanced, assuming the stock price and interest rates remain unchanged. It is a rigid scale keeping the market in harmony. Before we formally prove why this equation holds true, let us see it in action with a concrete example. Suppose a company's stock is currently trading at $50. A European call option on this stock with a strike price of $45 expiring in exactly 6 months or 0.5 years costs $7. The continuous risk-free interest rate in the economy is 4% or 0.04 in decimal form. We are asked to find the fair market price for a European put option with the exact same strike price and expiration date. We have been given every single variable in the put-call parity equation except for the put price. Continuing with our calculation, we start by writing down our foundational put-call parity equation. Next, we substitute the specific numbers from our problem into this equation. The call price is 7, the strike price is 45, the rate is 0.04, the time is 0.5, and the current stock price is 50. Now, we need to simplify the exponent on the mathematical constant E. Multiplying the interest rate of 0.04 by the time of 0.5 years gives us 0.02. This represents the total continuous interest accumulated over the 6-month period. Now we calculate the value of e to the power of negative 0.02, which is approximately 0.9802. We multiply this discount factor by the strike price of 45 to find the present value of the cash we need to hold in the bank, which is $44.11. Adding the $7 call option gives a total cost of $51.11 on the left side. Finally, we isolate the put price by subtracting the $50 stock price from both sides. The final answer is 1.11. This means the European put option must be priced at exactly $1.11 to keep the market perfectly balanced. Now that we have successfully used the formula, let us formally prove where it comes from by evaluating our two portfolios at expiration. Let S subscript T represent the unknown price of the stock at expiration. If the stock price is greater than the strike price K, you simply keep your valuable stock and the put option expires worthless. However, if the stock price drops below K, you use your put option to sell the stock for exactly K dollars. Therefore, the final value of portfolio A is always whichever number is higher, the stock price or the strike price. Mathematically, we write this as V subscript A equals the maximum of S subscript T or K. Now let us look at portfolio B, the fiduciary call. Remember, you have cash in the bank that has grown to exactly K dollars. If the stock price is greater than K, you take your K dollars out of the bank, use the call option to buy the stock for K, and you now hold a stock worth S subscript T. If the stock price is less than K, your call option is useless, but you still have your K dollars safely in the bank. Once again, the final value is whichever number is higher. So V subscript B is also the maximum of S subscript T or K. This brings us to the final step of our proof. Because portfolio A and portfolio B are identical in every possible future scenario, the no arbitrage principle dictates they must have the exact same value today at time 0. The present day cost of portfolio B is the call price C plus the present value of the strike price, K e to the negative RT. The present day cost of portfolio E is the put price P plus the current stock price S0. By setting the present day cost of portfolio B equal to portfolio E, we arrive at our final result, the famous put-call parity formula. To truly cement this idea, let us look at it visually. This diagram shows the final value of both portfolios on the vertical axis against the stock price at expiration on the horizontal axis. Notice the flat horizontal line at the level of the strike price K. This represents the protection. No matter how far the stock falls, your portfolio value never drops below K. Once the stock price exceeds K, the portfolio value rises perfectly in tandem with the stock, shown by the upward line with a slope of +1. Because both the protective put and the fiduciary call trace this exact same V-shaped path, their starting cost must be identical. So we have proven that this parity holds in theory. But what happens in the real world when the market makes a mistake? Sometimes an option is mispriced and the put-call parity is temporarily broken. This creates an arbitrage opportunity, which is a chance to make a risk-free profit. The strategy is simple. You calculate the theoretical fair price and compare it to the market price. If they do not match, you buy the cheaper side of the put-call parity equation and sell the more expensive side. This locks in a profit today while ensuring your future obligations perfectly cancel each other out. Let us look at a slightly harder, real-world scenario where we exploit such a mistake. Suppose we have the exact same setup as before. The stock is at 50, the strike is 45, the time is half a year, the rate is 4%, and the call is 7. We already calculated that the theoretical fair price of the put should be $1.11. However, you look at your trading screen and see that the put option is currently trading in the market for $3. Because 3 is greater than 1.11, the put option is significantly overpriced. We need to determine exactly how to exploit this. To exploit this, we must compare the total costs of our two portfolios. First, we calculate the actual market cost of portfolio A today. Buying one share of the stock costs 50 and buying the overpriced put option costs 3, bringing the total cost to $53. Next, we calculate the cost of portfolio B. Buying the call option costs 7 and depositing the present value of the strike price in the bank costs $44.11. The total cost is $51.11. We can clearly see that portfolio A is more expensive than portfolio B, even though they guarantee the exact same future payoff. Now we execute the trade. You sell the expensive portfolio A by short selling the stock and selling the put option, which brings $53 into your account. You then use $51.11 of that money to buy the cheap portfolio B, meaning you buy the call option and deposit the rest in the bank. Subtracting the cost from your revenue, you are left with a risk-free profit of $1.89 today. When expiration arrives, the payoffs perfectly cancel out, meaning you keep this profit forever with absolutely zero risk. We have covered a lot of ground today, so let us summarize the most important ideas. Put-call parity is the fundamental scale that balances the prices of calls, puts, and the underlying stock. It mathematically proves that a protective put and a fiduciary call are identical in the future, so they must cost the exact same amount today. If this parity breaks even by a fraction of a penny, traders and algorithms instantly execute arbitrage trades until prices fall back into line. Mastering this single equation gives you the power to understand market efficiency and build complex financial instruments with confidence. Great job following along.